Welcome to the Investor's Playbook, your voice in Scottsdale and Paradise Valley luxury real estate. Whether you're a seasoned investor or new to the game, consider this your edge. And now, your host, Frank DiMaggio. It's time!
Thanks everyone for tuning into the latest episode of the Investor's Playbook. We have a very special guest with us this week, Noah Brocious, president of Capital Fund. For those of you who don't know, Capital Fund is possibly the most active private lender in the market, especially for spec new builds and remodels in Paradise Valley and Scottsdale. Noah's been in the business a long time. Noah, why don't you tell us a little bit about yourself?
Yeah. So thanks. First of all, thanks for having me today. Appreciate the invite. Noah Brocious, president of Capital Fund One. I'm an Arizona native, married, got a 10-year-old son. Been in the business since 2009. We were buying properties at the trustee sale and doing fix and flips ourselves. Met some investors down there that needed some capital, made a few loans, and kind of took a step back and decided we liked the lending side of the business better. So created our fund and started raising capital and been growing it since then.
You know, being in the private lending business, I've always thought that guys like you see the most deals. You know, you've got real estate agents, you got investors like myself who are out there, and we're only going to be able to see so many deals. You're seeing so many deals come across your plate. Why don't you talk a little bit about just currently, what's the deal flow like? What are you seeing in the marketplace? And what are your thoughts on that?
Yeah. So right now we're getting about 800 to 900 loan requests a month. So that's, just to clarify, we're currently lending in Arizona, Colorado, Texas, Tennessee, and Georgia. So that's split amongst those 5 markets. We get a lot of deal flow on a monthly basis, and we typically fund plus or minus 30% of the loan requests that we receive.
You know, so as you're seeing all these deals, I mean, that's obviously a tremendous amount of deals that you're seeing. You know, the audience is going to want to know, you're picking 30% of those deals to fund. Why do you pick those 30%? Is it more the deal itself? Is it more the person that's asking for the money? Is it a combination of both? And if it is a combination, what's the most important?
Yeah. So, you know, we're an asset-based lender, which means we focus our underwriting on the property or the project. We obviously look at borrower experience too. So really the deals we like most are a combination of, you know, assets we like that investors are buying at a good price. And typically we'll lend to borrowers that don't have a ton of experience, but, you know, we typically like deals where borrowers have more experience as well.
Yeah. You know, and that's one of the things that I hear a lot when we get questions is, you know, you're doing these deals, fix and flips, you're doing new builds. You got to have millions of dollars. You got to have all this money to get into the market. I don't have all that kind of money. That's why I can't break in. And what you could probably speak on, which is what I see, which is if you hustle and you find the deal, there's always money out there to get the deal done. It's a question of really finding the deals. Don't you agree?
Yeah, absolutely. I mean, the money is going to flock to good deals. So yeah, even if you don't have a ton of your own capital, if you're out there scraping, finding good deals, you'll be able to find some debt from private lenders like us or others. And then there's equity out there.
Oh, yeah.
For great deals.
Yeah. I mean, you know, equity, you would think, how do I find the equity sometimes? It might be crazy to say, but even competitors, you know, even another builder would be happy to put money in. At the end of the day, if you fall down on the deal, they can pick it up. Yep. They're always looking to make extra money. And maybe usually are the guys who've got, you know, cash laying around.
Absolutely.
So one of the big questions I have is, you know, in the marketplace right now, specifically Paradise Valley and Scottsdale. I know you guys lend everywhere, but really this podcast is specifically about kind of Paradise Valley and Scottsdale. What are you seeing in the marketplace right now? Are you seeing more people looking to do spec new builds? Are you seeing more remodels? How's the deal flow just in those two markets? And just any other insights you can give us in that market?
Yeah. I mean, in both markets, deal flow is solid right now. I think we're definitely doing a good amount of spec construction loans, but there's still a lot of great remodel, fix and flip opportunities out there too. We were talking about it before, but, you know, a lot of people, the perception is that the real estate market isn't good right now. So now isn't a good time to invest. And I would completely disagree with that, because when we're in more of a balanced market like we're in now, or maybe even more of a buyer's market, that's the time when you can go out and really negotiate some good deals. Because historically, the way you make money on real estate is on the buy side, not like we were talking about, not banking on appreciation or bidding wars like we saw in late 20 through early 22. So yeah, now's the time to buy. A lot of times, you'll find a seller in the right situation that just wants to move on. Maybe they have a house listed for 800,000. You can go and offer them 700, close quickly, and a lot of times those sellers will take the types of deals these days.
Yeah, right now they are, for sure.
Yeah.
So, I know that you guys have had tremendous success as far as not having to take a lot of deals back. No private lender wants to ever take deals back, but occasionally, of course, you've got some of those. So when you're seeing deals that don't go exactly as planned, let's say, do you think it's more the deal or the operator?
Yeah, I mean, it's a little bit of both. I mean, I think in some situations, it's a borrower that maybe did too many deals at once. A lot of times somebody will maybe have a couple projects underway. They'll buy a property. They don't necessarily have the capital for that next deal because they're banking on one of the other three to sell. If those sit on the market and they don't have capital for that next deal, a lot of times that's what creates issues. But then there's obviously there's risk in this business, especially on the remodel side. I mean, even if you go in and do an inspection, if you're doing a major remodel, especially, there's times where there's things that you wouldn't have been able to figure out until you actually get in there. And there's times where maybe there's a foundation issue or something, major issues like that, where a lot of times a borrower will just do the math and say, this is a complete loser, even though I put a certain amount of cash down. I'm not even going to recoup that. So from time to time, people just walk away because of the project itself.
Yeah. Yeah. Right now, like you said, I mean, the market's somewhat normal, I would say. It's not real high. It's definitely not low. It's just kind of like a normal market cycle. I think we've had so much of a good market cycle for a while that people forget what a normal market cycle is like.
Exactly.
But you're going to get some investors out there, whether they be fix and flip or new build, who are going to put up a project, have aspirations of it being this big number. It's not selling. And I'd love to hear from a guy like you with your experience. What would be your advice for somebody that's in a situation like that?
Yeah, absolutely. I mean, I think, everybody gets rich on paper with their pro formas when they're going into a project. I would just say you got to listen to the market. If you have a property listed and, your pro forma said that thing was going to sell for $1 million and it sat on the market for a while and it hasn't sold, the market has spoken. So I think a lot of times people get tied to, no, I'm going to make $100,000 or $200,000 on this deal. But especially when you're borrowing money, I mean, every month, you're making a payment. So a lot of times it's just better to, look at reality, look at the fact that that property is not worth what you thought it would be worth, lower the price. Even if it means you don't make money on the deal, sell it, move on because there's going to be another deal tomorrow.
Yeah. And that other deal might be, one that's got a lot of white meat on it for you, a lot of profit on it. And the opportunity lost is if you got the other one and you're still hanging on, you might miss out on the good one.
Exactly. Yeah. Get your capital back and move on to the next deal.
Yeah. So another question that I get a lot is what are the most common pitfalls? What's the most common mistakes that investors are making that you've seen in the market?
Yeah. I mean, I think a lot of times you got to be realistic about what's a comp. A lot of times, and I'll see it in appraisals and things like that, or even comps that a borrower will send to us, where some properties, it's not comparable. It's 3 miles away. The lot's bigger. It's just a nicer neighborhood. I think you just got to be really realistic about what is actually a comparable property, because I think that's really one of the biggest pitfalls that we see.
Yeah, it's funny that you say that. I have a mentor, and he tells me that no one comp makes the market.
Yep.
Occasionally you'll see somebody who pays a bunch of money for a house because of a whole bunch of extenuating circumstances, and there's things about the project that you really don't understand,
right,
unless you really dig into it, and then all of a sudden everybody starts banking on that one deal.
Exactly.
I totally agree.
Yeah.
So we've got some first-time investors out there.
Yeah.
We have people who are really savvy and who have been investing in the market for 20 and 30 years who watch the podcast. And then we get people who are kind of first-time investors.
Yeah.
If you were able to talk to one of them, what would be the first line of advice that you'd give them?
Yeah, I mean, I think, you got to gain as much knowledge as you can by networking with people in the space. I mean, I think, especially over the last few years, I think people have more of a collaborative mindset, and
sure.
and other investors will help each other. So I think, you got to keep that in mind and not think, oh, that person's a competitor, they're not gonna give me advice. I think, talk to as many people as you can, gain as much knowledge as you can, and build as many relationships as you can. I mean, the people that we see have the most success, like yourself, they have people that know that they're active investors, and they've got real estate agents, they've got wholesalers, they've got a lot of different people that are sending them deal flow. So I think to really be successful at this business, you got to build relationships and see really good deal flow, because not every deal is a good deal. And a lot of times we see people get antsy, they want to do a deal, and because they're not seeing good deal flow, they'll buy a deal that maybe they shouldn't have just because they get a little impatient.
Yeah, and early in your career, that could be way more detrimental than obviously a lot later in your career.
I mean, some of the best deals you ever do are the ones you don't do.
Yeah.
Yep.
You're not the first person on the podcast that said that. You can believe it.
Yeah.
One of the somebody asked me once, they said, why are you doing the podcast? And I said, it is incredible. That's some of the things that I hear sometimes from extremely seasoned investors, builders, lenders who have been in the market for 30 plus years.
Yeah.
And, we're just talking real estate like everybody does. And they'll make a comment and I'll think to myself, that couldn't have been a serious comment. There's no way that they actually think that's what's going on.
Right.
And I think it's because they really don't have their finger on the pulse anymore.
Right.
They're just kind of in the background lending. Where you're at in your career, I think, you're at such a great spot, because you're not super early in your career where it's like, you're still trying to but you're not at that point in your career where it's like, look, this is what's always worked for us. And I think that's definitely a competitive advantage for you.
Yeah.
When you're having some of those conversations, because I know just like me, I talk to builders all the time. When you're talking to some of the other lenders who have kind of been in the marketplace for quite a while, what's some of the stuff you're seeing that you think they're kind of missing the mark on what it's like now?
Yeah. I mean, I think it kind of goes back to what I said before. I mean, a lot of people just think market conditions aren't great right now, so maybe it's not a good time to invest. I mean, other than that, I think, I think it comes down to, being patient right now. I think, some people, maybe if they're a lender, they've got capital available, and maybe they'll reach on a deal. Or maybe they're frustrated because they can't get their capital out. But and same thing on the investing side. I just think I am hearing from people that they're being a little impatient, a little frustrated. But you can't force a deal. I mean, anytime I think back on some of the loans that we've made that maybe haven't been the best loans, it's deals that we've forced. Even if it's not completely red flags, you might see some yellow flags, and you just say, it's okay, this one will be fine. But yeah, just being patient is important.
I think what not all of our listeners would understand is when you're in the business that you're in, the key is not only raising capital, but it's deploying capital. They think, oh, these guys have raised $1 billion. It's great if you raise $1 billion, but if you're only putting half of it to work, that's it's not really going to create great results for your line of business. So always kind of looking for deals. I can see how sometimes you would stretch because you got to deploy the capital.
Yeah, and the key for us, for other investors, like I said, is getting that deal flow. So you got to make sure you're doing everything possible to make sure you get enough looks so that you can be selective on the deals that you're doing, both on the lending side and on the buying side.
Yeah, and one of the things, one of the ways that I've tried to position myself in the market that's different than some of the other investors, I guess just kind of straight investors, is obviously I spent a tremendous amount of time as a real estate agent. And I think having those boots on the ground as a real estate agent is really my biggest competitive advantage to just being a builder. So I guess in your perspective, how much does the real estate agent play into it? Because sometimes you're probably having an agent and then I would assume some equity coming into the game, and then you're really the lending side. How big of a piece do you think is whomever that player is, as far as what kind of good deals you're seeing?
Yeah, I mean, I think a lot of our borrowers are an agent like yourself, and I think that's definitely an advantage, because I mean, I'm sure you've been on plenty of listing appointments where somebody wants to sell it for X, and you say, it's probably not worth that, and that a lot of times opportunities will come up where they say, man, I got to sell this thing quickly, and it's an opportunity for maybe you to take that down. So yeah, I think if you're not your own agent, you need to have a really good relationship with at least one agent, and a lot of times it's good to have a few different agents
Sure.
that you got solid relationships with, because some people are better in other areas or different properties than others. So yeah, I think that's important.
So let's just talk a little bit about the private lending business, because not everybody really is going to understand that. So number one, how has Capital Fund grown just in, let's say, Scottsdale, Paradise Valley, kind of this luxury market here in the past maybe 3 to 5 years? And then if somebody was interested in potentially working with you guys, what would that process look like for them?
Yeah. So I think 5 years ago, we had about a $250 million portfolio. Right now, we've got just about $1 billion out. So we've grown significantly.
Yeah.
And some of that has been the new markets that we opened, because we were just in Arizona until 2019, then started expanding into some other markets. So I'd say in the Arizona market, we've at least doubled over the past 5 years. So yeah, but the private lending industry in general has evolved a lot, since we started. I mean, back in 2009, there was a few people that were lending money. We had supply and demand on our side. We charged, back then it was 18%. Nobody negotiated, just because if there was money available, people were going to take it.
Yeah.
There wasn't 6 different lenders you could go to and pit them against each other. So, so yeah, it's evolved a lot. And we're a little unique in that the fact that we balance sheet the majority of the loans that we make. There's a lot of institutional capital in our space. Wall Street likes our space. There's, some of the bigger lenders out there are creating securitizations. There's a lot of groups out there that'll buy loans. And some lenders are set up where maybe they have a little bit of capital, and then they'll just originate and then sell those loans. So we're a little different in the fact that we do balance sheet the majority of the loans that we make, which allows us to move a little bit more quickly. But yeah, we've got right now our fund. We've got about 900 investors. We've got about 630 million in that fund, and then the remaining between that and the $1 billion, we use a few credit facilities to leverage the fund. So that fund's made up of private high net worth individuals. We only accept accredited investors. But yeah, I think it's a great place to invest money. I mean, we pay distributions on every month, which people like that monthly cash flow.
Sure.
And it's not like doing a new build where you got a ton of upside, but you also have some downside.
Sure.
Ours is pretty steady Eddie. Over the past 5 years, we've averaged returns of about 9.5% to our investors. So yeah, I think it's a good place to invest some money if you're looking for some cash flow.
There's a handful of deals I've done where I would kill for 9.5 for what I got at the end. So there's nothing wrong with steady Eddie road. So
yeah, for sure.
So the follow-up question I had was, if somebody wanted to get involved in possibly working with you guys, what's that process look like? Somebody who's never dealt with a private lender before, what would they do?
Yeah, on the meaning on the borrowing side.
Yeah, they find a deal, they've got their deal, they've got it wrapped up, they've got it under contract. Now they think to themselves, okay, what do I do?
Yeah.
How would they go about that?
Yeah, so we've got online on our website, you can submit a loan request. I mean, people can reach out directly to me, and then I'll get them connected with one of our loan originators. But we try to keep our processes as simple as possible. I mean, it's nothing like going to a bank or a traditional lender where it can be an interesting process. Every time I deal with a bank or a traditional lender, I'm reminded that we're going to be doing what we're doing for a long time. But like I mentioned, we're an asset-based lender. So for us, if somebody's got a fix and flip deal, we need a purchase contract, photos of the property, a rehab budget, and then past projects if they've done any. We don't check credit. We don't need bank statements or liquidity verification, and we don't do third-party valuations. So typically when we get a loan request, as long as we have everything we need, we can get the borrower terms within 24 hours, and then we can close within 24 hours after that, as long as title, buyer, and seller are ready to close.
So I have another question, tough question. So let's say, you're able to come across a deal, a luxury deal, where you've got somebody who just needs to move the property. They just want to get out of it. And they're willing to take $5 million for the deal. And they said, look, if you can give me a quick close, $5 million, that's fine. Now, an appraisal comes in at say 6.5, and then they need to borrow $1 million to fix it up. How does that deal look like? Are you able to use that 6.5 number if you're buying it right, or are you going to use that 5 number as kind of like what the value of the property is?
Yeah, I mean, for us, skin in the game is the most important thing. So regardless of how good of a deal a borrower is getting, we're always going to require a down payment. I mean, you kind of look back to 2008, 2009, where people were getting 100% financing. You see a little blip in the market, and people are throwing the keys back. So for us, not every deal goes as smoothly as everybody hopes or anticipates. So that skin in the game is really what keeps a borrower around if things don't go quite as planned. So for us to protect our investors and their capital, we do need that skin in the game. But the better the buy that you're making and the more upside there is, the less we're going to require. So it's not like an FHA loan where it's 3.5% down on every deal.
Sure.
We adjust the down payment based on that specific deal. So better deal, better buy, we're going to require less down, and vice versa.
And I don't know if you'll have an answer to this because it's kind of an in the weeds type question, but obviously you're seeing where people are buying the property, you're seeing what they're going to put into it up, and then you're seeing the out. So when you're seeing the out, you're seeing, if you're really digging into the numbers, you're seeing the spread. You're seeing, kind of how people did. What would you say is where you're seeing the best spread? Let's say percent wise, obviously dollars and cents. If you're buying a house for 10 million and you're selling it for 12, you're making $2 million, but it's still only that's only a 20%, lift. Somebody else might be making 50 on a smaller. So where are you seeing the best percent return right now in the market?
Yeah. And I would say on average, we do track that. I mean, what we don't know is, exactly what the borrower spent on the project. We know what their budget was. So you
got a good guess though.
Yeah, our best guess. And right now, profit margins are in the 20 to 30% range. The ones where we're seeing the best margins, honestly, is new builds and PV. Obviously, like we were talking about, that market's gone crazy. But what I'd also say is I've seen a lot of borrowers fail that, they were really good. They had a really good fix and flip operation, and then they saw the shiny object of a builder that really knows what they're doing, knows how to build a house, knows how to build it quickly, knows how to build it right. They'll see them making some big profit margins, and then they'll say all of a sudden, "Oh, I want to be a builder now." So I would caution people on making that jump. But yeah, the builders that have a team, know what they're doing, have made mistakes and learned through trial and error. I think those are where we're seeing the fattest margins right now.
Yeah. The market for the past, probably 15 years has been really good. I think you guys got into it kind of at a similar time that we did, and we've just kind of seen mostly all appreciation. What's kind of made me laugh is some of these, mentors, investors, people that have already been in the game and are kind of more on the lending side because they're kind of out. They've been predicting downturns for the past 7 or 8 years. And I joked with them, I said, one of these days you're going to be right. One of these days you're going to be right in that, yes, I'm sure there'll be a little bit of a slowdown or a downturn or something like that. Right. But the opportunity lost for them has got to be tens of millions. And I do have one kind of my main really mentor in this business. And, his philosophy is you should always be in the game. There's always money to be made. whether if the market's going down, you're buying, if the market's going up, you're selling, but that you should always be somewhere in the game. And if you're doing it right, you should be making money almost all the time. Yes, of course, there's going to be a few times where you'll have some down years.
Yeah.
So, when guys like me or really any investor finds a deal, the first thing they're doing is they're going to go out there and they're going to try to find their funding, and they're going to make a couple calls. There's definitely names in town that we all know. And you're one of the biggest ones. But sometimes people are just shopping the rates. They're looking and they're saying, oh, this guy's a quarter of a point less, or, they've got less points up front or something like that. And I'm sure you're all competitive, but what would be the big thing you think would make Capital Fund different than some of the other lenders that are out there right now?
Yeah. I mean, like I mentioned a little earlier, we balance sheet, the overwhelming majority of the loans that we make. So I think when you're looking at lenders, a lot of people, call themselves lenders, but they're really more brokers. That it's not really their own capital. And, I think it's a lot of times people will get frustrated and think, private lenders are being shady, because if somebody doesn't control the capital, a lot of times terms will change. And it's not necessarily that the lender went into it with the intent of changing the terms, but if they don't have control of the capital, they might not have final say. So I think, as you're out there looking for lenders, you kind of want to clarify, are you a broker? Is it, are you a balance sheet lender? So I think that's important. And one of the advantages of being a balance sheet lender, like I said, once we give borrower terms, those are the terms, nothing's changing. And it's our capital, so we can control how quickly the deal gets funded, especially if you've got a short closing window. I mean, can't tell you the amount of times we've gotten a call and somebody said, hey, XYZ lender said they could fund the loan. All of a sudden they can't fund it. I got to close by tomorrow. Can you close this loan? And we've been able to jump in there and get the loan funded quickly and save the deal. And there's a lot of different factors. There's interest rate, there's fee, there's leverage, but there's other factors. I mean, if it's a construction loan or there's a rehab holdback, you want to understand how quickly those draws are going to be funded. Because as when somebody goes out and does work on your project, they want to get paid yesterday. So if somebody takes 30 days to fund a draw, that's going to hurt your relationship with that sub or the supplier that you need to pay. Yeah. So that's something that's really important too. So obviously rate and fees are important, but you want to make sure that the lender you're working with is going to be able to close on time, and then they're going to fund those draws for you quickly.
I think when you're going into a deal, people are just looking at the rates and they're saying, oh, this rate's the best rate. But I think if you scale, at one point we had over 20 deals going. If you're scaling like that and you're doing draws that are $1 million and your lenders are not getting those draws paid quickly, that domino effect that could have, once that starts to kind of pile up on you, could be catastrophic. I mean, it'll have an effect on your relationship with your sub. It'll have an effect with the speed of the build. They'll bounce onto another project. Just the amount of things that could just kind of spiral from not getting your draws on time could be much bigger than that quarter of a point that you're worried about kind of in the beginning. Right.
And then the amount of time it takes you to finish the project and sell it. I mean, if all of a sudden you're not getting your money on time and it takes an extra 2 or 3 months, that's 2 or 3 more months of interest payments that are going to affect your profit margin. So again, the numbers, rates, fees, those are important, but making sure you're going to be able to get that project done quickly and sell it is as important.
Noah, thanks for joining us on this episode of the Investor's Playbook. And thank you guys for watching. Remember, you can stream us on all the major platforms. You can follow us on Instagram or TikTok. And if you've got any questions, please DM us or email us, and maybe we will answer them here on the podcast. Thanks again, and we'll see you next Tuesday.